Welcome to Markets Now. I'm Michelle Roque with Kent Beadle, Paradigm Futures. We did see mostly higher openings this morning in both grain and livestock futures, but right now we have seen a little bit of back and forth action over in the cattle. Everything else still to the plus side. And Kent, let's talk about the grain trade higher despite basically some bearish outside markets. So talk a little bit about why you think we're higher this morning.
Well, there are a couple of just basic fundamental reasons. We've been seeing gradual increases in basis levels for corn and soybeans. We've been watching the spreads tighten up. Very interesting to see that the March-May corn spread is now trading tighter than 10 cents. We've traded the March-May bean spread into about 7.75 to 8 cents. Those are significantly tighter than just a week or two ago, and I mean it suggests partially maybe a lack of selling from the farmer, but it also might just mean some pretty solid demand for our commodities at these lower prices, and that's certainly reason number one. The second reason is, the oversold nature of the market and maybe the size of the speculative short. At some point in time here, we have to ask ourselves: is the bearishness of the balance sheets, particularly in corn, adequately priced into the corn market? I know that there are a lot of bears out there who feel that we should be cheaper than this, looking back at their history of 2014 through 2019, thinking that this type of a carryout, deserves corn with a 3 in front of it. My retort is that we had much different, cost of production fundamentals then than we do today, and I do think that we probably shifted our curve up here a little bit, and at 440, 450. Based on the math that I've been doing with our client base, it's just not very profitable. Corn production is not going to make the American farmer very much money at all, if any, unless you're very well heeled, you loan your land, you don't have any debt, you are able to spread your own fertilizer from a livestock production situation or something along those lines. Renters who are out buying fertilizer, even though fertilizer is lower, but at more expensive seed, more expensive labor, more expensive chemical, more expensive land, it just doesn't work. And so, at some point in time, we're kind of stretch the rubber band, and it feels like the rubber band might be ready to snap here a little bit. Yeah. And that kind of was what is going on.
Yeah, of course, we had the reversals last Thursday, and so that also probably caused maybe a little bit of this selling to stop from the speculative community. But put into perspective, I guess, just how short the specs are in this market. They're not record short, but pretty darn short overall.
Yeah, in soybeans, the work I did last week, the combined short position, and this is the net short position, in soybeans plus soybean meal plus soybean oil is the largest since 2019, when we were in the midst of the trade war and we had lost our soybean market to China. The corn short is, within 20,000 contracts, give or take, of a number of other times when we've maxed out our short position. The wheat market had made a new record short combined between Chicago, KC, and Minneapolis. It had rebounded off of that, but is now moving back down toward that level. We're just historically, very overstretched to the short side in all of our commodities.
Okay, so let's talk about resistance areas here on the corn. Where do we need to get above from a chart perspective to keep going in both corn and soybeans, actually?
Yeah, so let's start with corn. You had an old low at 447. You'd like to get a close above that level to begin with. Certainly 450 is a nice big even number, and you'd like to close above that as well to get a little bit of momentum. That was today's high, and we tested that a little bit last week and couldn't get above it. So those are real short-term ideas. Better resistance probably up at the 50-day moving average, which is up in that 473 area. And I think that would be a reasonable target for
Yeah.
a more significant correction. In soybeans, we got a long ways to go to hit any resistance. I've got 1284 as an old low, and then there's a gap up around $13 that we gapped through after the first of the year.
And wheat is up for the fourth day despite a bigger Australian crop estimate and all these shipping issues that we keep talking about.
Yeah. Same issue. There's not much bullish news out there. Didn't really like yesterday's export inspections report, although we do have to note that we did load some of those China sales, so that was some good news. But in general, I think it's just kind of the same issue when we've dropped Chicago wheat down into that 480 to or 580 to $6 area. It's stimulated a lot of world demand. It's been an area where the Egyptians, for example, get into the world market and start buying wheat, and of course a prior break into that area stimulated some of that Chinese demand. So again, just feels like maybe it's cheap enough, and we're due for a bounce.
What impact are the shipping issues that we talk about having on freight rates? They are going up, aren't they?
Freight rates have been significantly higher, and the thing is that they have a negative impact on demand until they don't, which means essentially that if you can wait out the situation and wait for things to calm down, you would expect then that shipping rates would fall back. So we had a couple of weeks there of some pretty poor export sales right around the first of the year, and those higher shipping rates had something to do with it. But the shipping rates haven't come down, and eventually the end user needs to buy what they need to buy. And we've seen export sales pick back up again, and ultimately it's just a question of who ultimately has to stand those higher shipping rates. Initially it flowed back to the farmer through, and now it appears that the end user is going to have to pay up and start to pay some of that shipping in order to get what they need.
Gotcha. Cattle and hogs have both been two-sided now this morning. Let's talk about the cattle market. A lower day yesterday after a neutral cattle on feed report. This market really could use some direction from cash, because we didn't have much last week.
Yeah, dollar higher, but on very, very light volume. I like the direction of the market. Ultimately, I feel like we're going to be able to take cattle, probably $6 to $8 higher. We've managed to get up into that 38% retracement area. I'd like to see it get up into the 50 to 62% retracement of the break. I think that's a reasonable objective. And I think ultimately that the cash trade will allow us to get there. I like the fact that the stock market is making new highs and keeping the consumer feeling, fairly confident right now. But I'm not sure that we're going to be able to get all the way back to the highs that we made here this fall. I know some analysts who think we can. That might be a stretch.
But we are getting the box beef market basically helping us out, aren't we?
We are. And of course, some of the weather issues that we had a couple of weeks ago gave that a little bit of a boost as we had to slow down slaughter, especially a couple of weeks ago. We're trying to catch that up. The best thing that could happen is we can keep these cutouts high as the slaughter catches back up. If we can do that, that'd be a really good sign for the market.
Well, and last week we talked about hogs being down because of the processing chain speeds being slowed because of the weather. Are we getting back to normal there enough where this market is starting to get through those numbers now?
Yeah, well, and of course, some of the same thing there. You had a little bit higher cutout as a result of those slower chain speeds, and so you have that spread, and now you're starting to catch the slaughter back up. Here again, we're up $1 here today, and we had 2 weeks ago a very nice week. We had just a corrective inside week last week. If we can go and take out the highs from 2 weeks ago and from last week, it would be very good technically. And of course, there are still fun shorts in the hog market right now, so that could give us a boost.
Okay. Thanks so much for joining us, Kent Beadle, Paradigm Futures. That is Markets Now.